What is a dividend? A dividend represents a share of a company's earnings distributed to its shareholders, a decision typically made by the company's board of directors. Dividends serve as a form of reward to shareholders for their investment in the company's equity, commonly originating from the company's net profits. While profits may be retained within the company for future business activities, any surplus may be allocated to shareholders as dividends. Even in periods of adequate profits, companies may continue to make dividend payments to uphold their established track record of distributions and reward their shareholders. Here's an example of a dividend. If a company's board of directors opts in for an annual 4% dividend per share, and each share is valued at $100, the dividend would amount to $4 per share per year. If distributed quarterly, each installment would be $1, totaling $4 per share annually. Why do companies pay dividends? Dividends serve as a means for a company to maintain investor interest and trust. While a high-value dividend can indicate a company's financial strength and profitability, it may also suggest a lack of reinvestment opportunity, leading to cash distributions to shareholders instead. A company's decision to reduce or eliminate dividends may signal financial trouble, but it could also represent a strategic move to invest in projects with potential long-term returns for shareholders. So it's important to understand the company's roadmap when evaluating the company's possible return on investment versus dividend distribution. How often are dividends distributed to shareholders? The frequency and payout rates of dividends are determined by the board of directors. Dividends can be distributed regularly, such as monthly, quarterly, or annually. Additionally, companies may issue one-time special dividends in addition to scheduled distributions. What can you do with a dividend? Upon receiving dividends, investors have various options based on their financial situation and goals. Keeping dividend payments can align with certain investors' financial objectives, providing recurring cash flow, particularly for retirees and businesses. Investors seeking continued growth can reinvest dividends through dividend reinvestment plans, also known as DRIPs, which enable the purchase of additional shares over time. Dividend stocks play a crucial role in a well-balanced portfolio, offering both income potential in the short term and opportunities for long-term growth. There are many types of dividends. Cash dividends are paid out as cash amounts to shareholders, usually on a quarterly basis. Stock dividends distribute extra shares instead of cash, but also have the potential to dilute the share's value. Property dividends are assets or inventories distributed instead of cash that are based on fair market value. Liquidating dividends are paid out during a partial or full liquidation of a company. This type of dividend helps return shareholders' original contributions and is usually not taxable. Every investing strategy involves risk, and dividend investing is no exception. The biggest risk is that dividends are never guaranteed. Diversification should always be top of mind for any investor who is looking to mitigate risk and have a well-rounded portfolio. Don't forget to subscribe, and thanks for watching.